Have you ever wondered how you can invest in commodities like oil or gold without actually storing barrels in your garage or bars in your safe? It is a fascinating question that many investors ask. Commodity exchange-traded funds, or ETFs, replicate the performance of a commodity index primarily by using financial instruments such as futures contracts, total return swaps, or in some cases, by directly holding physical commodities. Their goal is to mirror the price movements of the underlying commodity or index they track, providing investors with exposure without the complexities of direct ownership. The most common method involves futures contracts. These are agreements to buy or sell a commodity at a predetermined price and date in the future. ETFs achieve their replication by continuously buying and selling these contracts. When an existing contract approaches its expiration, the ETF sells it and buys a new one for a later date, a process known as rolling futures. This rolling process is critical because it avoids the need for physical delivery of the commodity. Another method involves total return swaps, which are agreements with a financial institution to exchange the total return of a commodity index for a fixed interest rate. Less commonly, some ETFs directly hold physical commodities, like gold bullion, requiring secure storage and insurance. For investors, understanding how a commodity ETF replicates its index is essential for managing expectations about performance. To assess an ETF, you should review its prospectus, which details the specific financial instruments it uses. Consider whether the ETF employs futures, swaps, or physical holdings, and investigate its expense ratio. This will help you choose an ETF that aligns with your investment strategy and risk tolerance. It is important to be aware of certain market dynamics when an ETF uses futures contracts. Sometimes, future contracts for a commodity are more expensive than the current spot price, a situation called contango. Conversely, when future prices are lower, it is known as backwardation. These conditions can affect an ETF's performance because rolling futures in contango can create a drag on returns. ETFs using total return swaps introduce what is known as counterparty risk, meaning the risk that the financial institution backing the swap might default. Ultimately, the way a commodity ETF replicates its index performance directly impacts its tracking accuracy and potential returns. By understanding whether an ETF uses futures contracts with their rolling complexities, total return swaps with their counterparty risks, or physical holdings with their storage costs, you can make a more informed decision and better align your investment choices with your financial goals.